the day has finally arrived. The book, Goals-Based Investing, has arrived on bookshelves and is now available for sale. And here to talk with me about it is the author of that book, Tony Davidow. Tony, welcome.
Thanks, Bob. It's an exciting day.
So it was a long journey for this book to actually hit the shelves. Just for a moment, tell us a little bit about the journey and some of the complications.
Well, let's be honest. It took me a couple months to write it, but it's really the culmination of 35 years of traveling across the country, meeting with clients and advisors. So I'd like to focus on the longer journey, which was really just watching the industry evolve. It's been fascinating to watch the industry evolve, how advisor practices evolve, how the menu of options have evolved over the years. And it was just my opportunity to kind of reflect on that, put it all into writing here. Most recently, though, I think what you're referring to is we've certainly dealt with some supply chain issues, which may not get the media attention as chip shortages, but we had some supply chain issues, we had pulp shortage. But to your point, the book has arrived. Very excited to have it here and very excited to have people read it. I'd love to get the reaction from folks.
Right. And so when I think about the book, we've talked about this, the various chapters in the book. Remind us who you wrote the book for.
Yeah, there's really two primary audiences. One is the advisor that I refer to as the lifelong learner. And those are the advisors, Bob, that you and I are very familiar with, who have really taken the time to invest in themselves, to evolve their practices, evolve the menu of options, and really evolve the way that they serve clients. And I think those are the obvious ones who are looking to understand the journey that we've been on, and more important, where that journey is going to take us into the future. But the other dynamic, and this is something that I think I really want to talk a little bit more about today, is I really also wrote it for high net worth investors who often have a difficult time. I think as an industry, we often make things more challenging than they should be. We use a lot of industry jargon. A lot of firms profess to provide the same sort of services. And I think it's very confusing to investors to understand the differences between the firms, the difference between the capabilities. And I think there's also sometimes a lack of transparency in what we do. And I really thought it was important to kind of unveil some of that and really help advisors and investors kind of understand the distinctions between the firms and how they work.
Right. So when I think about decoding Wall Street, there, as you mentioned, there are numerous terms that seem to make it difficult for the average or even the not so average investor to understand what's going on. You talk about things like revenue sharing and payment for order flow, which is a timely topic, and then also affiliated products. Talk a bit more about that.
Yeah, I think the popular rhetoric in the financial services industry is all of these things are free and low cost is really the important thing. And I think that low cost is important, but I would argue you get what you pay for, and unfortunately, you don't get what you don't pay for. And a lot of these firms that profess to offer these free services have a lot of hidden costs. And hidden costs can be in the form of affiliated money market funds, where all of a sudden the firm collects revenues, or revenue sharing where asset managers and mutual fund companies pay to be on platforms, or the use of affiliated products. It appears there isn't an advisory fee. Well, maybe there isn't an advisory fee, but the firm is being compensated in the form of using affiliated products where there's a management fee built into it. And then, of course, payment for order flow is something that has got a lot of attention with some of the issues associated with Robinhood. I actually wrote this book in January. I delivered the final manuscript, and a lot of these things have been coming to the forefront over the last couple of months. But I would argue there's nothing wrong with any of these practices per se, but I think we need to be transparent about it. I suspect most investors don't understand those things. And candidly, a lot of advisors don't, because it's really hidden at the headquarter level.
Right. And you suggest that to earn investors' trust, the industry needs to be more transparent and maybe even reveal the conflicts of interest that they have.
Absolutely. And I do think it is imperative that we earn back investors' trust. We've lost it a bit over the years. And I just think being more transparent, being more open about it, again, not that any of these practices in and of themselves are wrong, but we need to make sure that people understand it so they can make better informed decisions.
Yeah, it's interesting. There's a debate going on in some circles about the notion of more disclosure doesn't necessarily create a better informed investor. Any thoughts about that?
Yeah, I think sometimes if you over disclose, you now have this very long disclosure and people don't read it. right? You're kind of overwhelming them with information. It's like looking at a mutual fund prospectus or an offering memorandum for a hedge fund. You have so much information out there. There's no way that people will spend the time to really read it and fully understand what it is. But I do think that we as an industry need to do a better job of being transparent, being completely open and honest with investors so they can make informed decisions.
So the book obviously is quite timely, given your mention of Robinhood. Talk a little bit about why you think it's so relevant today, what you've written.
Yeah, I think if we think about where we've been in the last decade, we've seen enormous changes. We've seen enormous changes in the way that advisors have evolved their practices. We've seen a lot of changes in the expansion of the investment options available for investors. But I would argue also, investors are much more discerning. They want and expect a lot more from their advisors. So we as an industry have changed a lot over the last decade. And I suspect over the next decade will continue to change, and maybe at even a faster rate. I think COVID, in many senses, accelerated the rate of change. So I really thought it was important to memorialize where we are and where we're going, because I think sometimes you get so caught up in the moment and we try to hang on to the past. For folks like you and I, we embrace change and we get excited about how the industry has changed. And I know some people are reticent to think about changing because they think it's a threat to them. But the reality is there's no looking back. We're on a different sort of journey here, and we've got to anticipate what the future looks like, how we serve clients, the investments that we're bringing to them, and ultimately what the overall industry looks like tomorrow, I think will be very different than the way it looks today.
So speaking of things that will look different tomorrow, you've made some predictions about what you think will happen over the next 10 years.
Yeah, and I think of
and we won't hold you to them. I think but if you're right, we will give you credit.
So I think of Byron Wien. I was at Morgan Stanley for many, many years. And one of the things that Byron used to do when he came out with his 10 predictions is he didn't want the safe bets. So when I was thinking about this, to make the safe bets, who cares? So I wanted to be provocative. So I have a series of projections that I've made in the book. I'm predicting that the industry will look very different, right? We tend to be a white male-dominated industry. I'm hoping to see more women and more minorities. I think we're starting to see a bifurcation of advice where at the high end of the market, high net worth investors are going to demand highly customized solutions. The lower end of the market, we're starting to see robo offerings kind of fill out the needs there. I think because of that, we're starting to see the creation of more super teams, large teams, because of the complexities of serving high net worth families. I think ESG becomes mainstream. I think direct indexing certainly starts to take hold. I think the RIA segment continues to grow. We've seen a lot of growth in that space. I think it's only going to accelerate in the future. Something you and I have talked about, I think private markets will continue to be more accessible to more investors. But as you and I talked about in a recent Market Watch article, there's still a need for education there. Just saying that we want to go there is one thing. Getting there and really preparing the market for is something else. I think one of the more provocative things is I think there's the likely emergence of a non-traditional competitor. Think of a Google, Apple, or Walmart, and they've already made some indications that they're interested in getting into our space. If the lower end of the market is dominated by smart algorithms, don't you think some of these tech giants who really have invested an awful lot to understand behavioral biases and propensity models, how investors react to things, don't you think they would be a formidable competitor if they entered our space? So I think stay tuned on that one. That's one of the more provocative ones. I think we're likely going to see advisor ratings, but not the advisor ratings that we see now, which are largely driven by firms nominating advisors who have a lot of assets. But maybe advisor ratings more like a Yelp-like app that allow us to differentiate between the types of service, the diversity of the practices, the types of clients that they serve. And then my last one, which probably isn't super surprising given my focus, is I do believe that goals-based investing becomes very mainstream, very well accepted across all of the market segments out there, because I do think it is the natural evolution of our business as we move beyond chasing returns and trying to beat the market to really trying to solve for what are the various goals and objectives of each family unit.
So I just came back from a conference, Tony, where Bob Veras was speaking and talked a good deal about where fees are going in the world of investment advice. And at the moment, the vast majority of advisors are charging perhaps a asset under management fee. Any thoughts about what happens to fees in the decade ahead?
Yeah, I do cover fees, and I do think that fees absolutely are going to change. And I think Michael Kitces has done some great work looking at the segment that he's looking at, and what he has shown, which is where I think we're going, is more and more advisors are using either a combination of subscription fees or maybe retainer and subscription in tandem with one another. So I do think it will change, and I think part of the reason I've been pushing for this change for several years is, while the asset-based fee is better than commission because you move away from transactional-based advice, it only focuses on the portfolio. And if we as an industry have evolved and we're now focusing on such issues as trust and estate issues and financial planning, retirement planning, and dealing with large concentrated positions, we're not being compensated for that. So we need an advice model that actually reflects all the services and all the value that are being provided. And I think some form of subscription-based model or retainer-based fee is more appropriate given where I think we're moving as an industry.
Right. And you mentioned advisor ratings. I'm interested in this in part because the SEC recently created a new testimonial rule that in effect allows advisors to have their clients give testimonials. And it also allows for advisor ratings like Yelp. And I think this is everywhere except in the advice field at the moment, right? Plumbers, electricians, professors all get rated on Yelp-like services. And the time has come for this to happen for advisors.
I think it does. And by the way, it doesn't have to be within the SEC purview, because it could be an independent, again, Yelp is merely out there. It's really the users who are providing the ratings. It's not an independent body who's subjectively evaluating, the quality of the advice, the quality of the team. It's actually the users. And I think that's the more reflective of, the value of advice coming from an advisor practice. So I do think that is something very real. And I think that will happen. And, again, I would argue that either advisors prepare for that and they think about how they may be perceived by the outside world, or unfortunately, they may not like the way that they are rated, and it could clearly impact their business going on. So I think that's one of the more provocative ones. But I think the reality is we're going to get there one way or the other. And I'm not sure it has to be SEC sanctioned. I think it could be as simple as just some sort of an app where the users are providing all the inputs.
Yeah. So I have an unlimited number of questions to ask, but I'm going to limit it to just one, which is when I think about the future, I think about the regulatory environment. And there's been much discussion about the SEC regulates this body of advisors, and FINRA regulates this body of advisors, and maybe state securities divisions regulate a whole nother body of advisors, and insurance commissioners and regulate another body of advisors. Any thoughts about where the regulatory environment ends up over the next 10 years?
I'm certainly not an expert, but I would hope that we would have a common regulatory framework. And, something you and I have talked about a lot over the years is this whole fiduciary sort of rule. To me, it's kind of a shame that it became a little bit of a political jump ball. It seems to me that all advisors should be held by the same standard. As you know, I worked at a large wealth management firm, and I remember our compliance people telling us, well, sometimes you have a hat on, sometimes you have a hat off, sometimes you're a fiduciary, sometimes you're not. And I always I was troubled by that, because I didn't think that the client knew whether you were acting in a fiduciary capacity or not. So the easiest and simplest way of thinking about it is to harmonize all the regulation, hold all advisors to the same standard. I think that would be good for the industry. And again, it goes to your earlier comment about it would help us earn back the trust of our investors and our clients if we're all held to the same standard and the same level of accountability and transparency. And that would be the fiduciary standard.
All right. Well, I think that's as good a place as any to wrap up here, Tony. The book is called Goals-Based Investing. I have my copy. You can get your copy at Amazon and Barnes & Noble and wherever books are sold, Tony.
Absolutely. Thanks so much, Bob. This has been a great series, and I'm really excited to have people read the book, and certainly feel free to reach out to me with any of your input.